top 3 most important things that somebody that's preparing to go through the home buying process, it's going to be using a home loan. What do they need to do to prepare and get their credit profile, credit score ready? Top 3.
Number 1, review your credit. Pull a credit report right away. I recommend CreditZtilowGroup.com. That's a new vertical that I have that is a FICO. It's an accurate FICO for a fraction of the price that's available, and you can update it twice a month. Wherever you get it from, though, I don't care. Look at it. And you got to agree with what's on your credit report. Number 1, if there's something that you don't agree with or that's hurting you, you have to deal with it one way or the other. Do not go and just start paying off collections. That will drop your credit scores by updating the date of last activity, okay? So if you see collections on there, if you see charge-offs, you can get a hold of Kelly and her group. Then the thing that you control is credit cards. You can pay those credit cards down. The lower you get them, the better your scores are going to be. There is some pay down strategy, though, where you want to get as many cards below 50%, 30%, and 10% as possible. You don't want to use all of your funds to pay one down while leaving 2 maxed out or above 50%. So look at your credit, address collections and charge-offs, get credit cards paid down. Those are my 3 top ones.
I love it. And for those people that want to see their credit as you recommend, they can all go to annual credit report. Yes. It's not going to have scoring, but it will tell you, kind of show you trade line by trade line, what is on your credit. And it's a great free place to start.
Absolutely. Yep. And an annual credit report is one that won't sell your information like a Credit Karma will. Because remember, if you get something for free, if you don't pay for the product, you are the product. Right? Annual credit report is the exception. So go there, know what's on your credit report. Absolutely.
Yeah. And I'm so glad that you kind of talked about credit cards and revolving credit, because it is like the fastest way, assuming that everything else is good on your credit report. You haven't had any 30-day plus late payments, haven't had any life activity that has impacted your credit score. But if you have maxed out, especially this time of the year, so we're post holidays, maybe you had a big Christmas, and maybe that $10,000 limit on that Visa, you maxed out. So you now owe $10,000. Even if you've never had one late payment, that ratio is going to impact your credit score. So as Sam mentioned, resetting that balance and know the thresholds at that 50% mark, the 30% mark, and the 10% mark. And by that, I mean the balance in relation to the limit. And it's per credit card, not overall credit usage. And I think that by itself is such an important piece of knowledge that a lot of people don't know about.
Yeah, absolutely. And the thing to keep in mind with the credit cards is, because people will get stuck on that, they look at the overall. Your overall does factor in, but it's going to be affected no matter what by the granular efforts that you make on the individual. So like if you're going to pay $3,000 down in credit cards, you're going to get $3,000 less on your overall balance, but how are you using that $3,000 amongst your 2 or 3 credit cards? That's where you can be strategic and have fun and start to really love credit as you see that you are in control of it. And then, oh my gosh, it got me access to hundreds of thousands of dollars, which then in equity over the next 3 years in this market, almost, doubled my money. That's amazing. Like that will happen for people when they stop looking at credit as an enemy and more as an ally.
Absolutely. And it isn't just about accessing those hundreds of thousands of dollars to be able to buy your dream home. It's also the cost of money. And I think that's another piece of it, depending on the loan program that one is using. If we just focus on Fannie Mae and Freddie Mac, they have what are called LLPAs, loan level pricing adjustments. And those pricing adjustments are in fact what it sounds like. That means an adjustment to the interest rate or the cost of the loan. And a big driver of that is going to be credit score and down payment, and then occupancy. So what are you going to do with the house? Is it a primary residence, second home, or investment property? But credit score drives that. So you can just see from a interest rate standpoint, if you fall below, let's say a 720 and you're doing 10% down, the nuances of the cost of money based on credit score is so much more, I would say, like this just happened, another year, about a year and a half ago, where Fannie Mae and Freddie Mac FHFA updated these loan level pricing adjustments. So now it's mind blowing what drives the cost of money just in that particular loan program strategy. I mean, it's crazy. So sometimes that takes people out of the conventional conforming type of loan into an FHA loan that doesn't have the loan level pricing adjustment equivalent. So it's an ever-changing world when it comes to home lending, and credit is such a big part of it. And Sam, I really appreciate you. I know my credit guy's been around for many years, since 2015, right?
Yeah. Yep. 2015.
And you've got a whole team over there. So if you're needing assistance, you're not really calling Sam probably, but Sam's got a great team of people over there.
Absolutely. We're here to help, and we're happy to do it.
Yeah. Well, thanks, Sam. I appreciate your time today. We'll see you soon.
Thanks, Kelly.